We continue our discussion of speculations, gambling, with a chapter on buying on margin and selling short. We once again turn to Mark Twain, famous American author, who said October. This is one of the peculiarly dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and of course, February. Again, Samuel Clemens, the author, lost a lot of money speculating, and so Mark Twain, the actual writer, the pen name, put it to pen and made it humorous, but also very, very astute. Don't do it. And which is why we're explaining to you how it's done, but we hope you don't do it. In this case, buying on margin may be something that eventually you want to do, maybe. Not now, not until you've built up a solid portfolio of high quality stocks. But selling short, folks, never, never, never do it. So if you don't want to learn everything that's in this chapter, all you want to do is find the questions that are going to be on the final and find the answers. That's fine with me. Just stay away from these darn things. But if you are thinking about getting into the industry and someday we'll learn enough to take this Series 7, then you want to go through it because it's going to take a long time, folks. It's like options. It's very like options. Very tricky. Don't zig when you should have zagged. But it's still fascinating, if only to not know that there are people doing this and losing their shirts, and actually some of them are making money. I wish them a lot of luck. They need it. A cash account. What's that? Well, this is a brokerage account in which all transactions are made on a strictly cash basis. And this is the way most people start off. Simplest arrangement. Cash accounts are the simplest arrangements requiring no credit check of the customer by the brokerage firm. Once you've established a good relationship with your brokerage, most brokerage firms will allow you to purchase shares of stock even if you do not have enough cash in the account. This is because stock transactions settle in 2 days. You have 2 business days to get the money into the account. Now, some deep discount internet brokers, and I know Scottrade used to do this, I don't know, but because they're gone. They got bought by TD Waterhouse, TD Ameritrade, which it used to be TD Waterhouse, and they merged with Ameritrade, became TD Ameritrade, and then they got bought by Schwab. So I don't know if they still. I don't know if Schwab still does this. Does not allow this. But most, if you have a personal relationship with your broker, they will usually say, yeah, get the money in 2 days. And conversely, you sell a stock, it actually takes 2 business days to receive the money. But again, you get to know your brokerage firm. They'll say, hey, we'll send it to you tomorrow. Don't worry about it. Come pick it up. Here's the check. They know it's coming, right? So they'll spot you the money for now. That's how many people buy and sell their securities, their stocks in this case. We're going to mostly talk about stocks, but you can do it with other securities. A margin account, on the other hand, is a brokerage firm in which, subject to certain limitations, securities, and we're going to mostly discuss stocks, can be bought and sold on credit. If you open a margin account, the brokerage firm is going to do a credit check to determine your credit worthiness. They're going to run your credit report since you're going to be borrowing money from them. And the interest rate that you pay on the money borrowed is actually a pretty good rate. It's called the margin rate. It's actually a very good interest rate. It is often the prime rate plus 1 or 2 percentage points or 2 or 3 points above the current money market rates, depending on how much you borrow. That's a whole lot less than what you pay with your credit cards, so it's not bad. Kind of like a home equity line of credit, a little bit more than a home equity line of credit, but still, it's a pretty. If you are into borrowing money, if you need to borrow money, my personal belief is you should make love, not loans, but that's Business 121, financial planning and money management, so we won't discuss that here. So a margin account allows you to perform what is called margin trading, buying on margin. A leveraged account. There's that word again, leverage. The use of borrowed funds to purchase securities. This can magnify your returns by reducing the amount of equity that the investor must deposit. Now, if you're already saying, what's the catch, Payano? You are doing great, because indeed there is a catch. It can magnify your returns and magnify your losses, indeed. Ain't nothing free when it comes to investments, right? The financial world. So the margin is the portion of the value of an investment that is not borrowed. And I always thought it should be the other way around, right? But no, it's the part that you came up with. So the amount of equity that is stated as a percentage of the investment. So you came up with 75% and borrowed 25%, or you came up with 50% and borrowed 50%. That's the margin. I always thought it should be the other way. It should be the part that you borrowed, but that's not how it works, and I don't make the rules. Buying on margin allows the investor to use financial leverage, the use of debt financing to magnify investment returns. Buying on margin also allows an investor to tap into the equity in their account without actually selling their investments and in generating commissions and taxable transactions. You know, folks, buying on margin is much like buying a house, right? When you purchase a house, you don't come up with the total amount. You deposit 10 or 20%. You finance the rest. Well, stocks require at least 50% down because stocks are far more volatile than real estate. But it's the same idea. You're borrowing against the value of the asset, whether it be real estate or a stock or a bond. And we'll just discuss stocks because that's mostly what are used, but you can do other securities. Let's take a look at some of the mechanics of buying on margin. There's a margin requirement called the initial margin. That's the minimum amount of equity that must be a margin investor's own funds. Now, believe it or not, this is set by the Federal Reserve Board. Why? Because they consider it kind of like banking. And so they say, hey, we're going to call the shots. The margin requirement is 50%. You must deposit at least 50% of your own funds. Now, that can change, but it's been 50% for decades, so I don't think it's going to change anytime soon. This allows you to purchase the same amount of stock with less money, financial leverage. The margin loan is the amount, or also called the debit balance, is the amount of your account that you borrowed. So the margin is how much you came up with. The margin loan is how much is borrowed. And you must deposit at least 50%. Now you can deposit more, but the minimum requirement, the initial margin, is 50%. Here, let's take a look at an example. You deposit $10 and you borrow $10 from your broker. Okay, the initial margin is 50%. The margin loan is $10. The margin is $10. You came up with $10 and you borrowed $10. Now, you purchase one share of stock for $20 and the market price rises to $30. You made $10 on a $10 investment. Congratulations. This is half of what you had come up with when you simply purchased the stock outright with your own money. So if you had bought the stock with your own money at $20 and it went up to $30, that's a 50% return on your investment. But instead, if you borrowed $10 and the stock rose from 20 to 30, you made 100% on return on your investment. Woo, woo, woo! You see, buying on margin can magnify your returns. What happens if things don't go as planned? Slide number 8, buying on margin example revisited. You deposit $10, you borrow $10 from your broker, you purchase one share of common stock for $20. It's the same as before, but this time the market price drops to $10. Oops. Only half of the money was yours. You borrowed the rest. You have lost your entire investment. You see, if you bought it at $20 with $20 and it went down $10, you lost 50%. But because you only came up with $10, borrowed the other $10, and it went down $10, you lost 100% of your investment. Margin buying was one of the major contributing factors to the crash of 1929. At the time, the margin requirement was only 10%. Hey, stocks are like real estate now. You only have to come up with 10%, 20% to buy a house. Hey, you only have to come up with 10% to buy a stock. Bad idea. It turned out to be a really bad idea and led to the Great Recession, although there's some controversy about whether the stock market crash of 1929 led to the recession, the Great Depression, or was it the response of the Federal Reserve Bank, which was only around for like 12, 13 years then? Did they make a big mistake? And interestingly, the folks who were in charge at the time of the Great Recession, the global financial crisis of 2008, they were students of this. Bernard Bernanke, what's his name? Bernanke is his name. I can't remember his first name. My apologies. And Timothy Geithner, and who else? The other guy. I'm forgetting their names. But they were all students of the Great Depression, and they said, look, we're not going to make the same mistakes they did then. And other people said, you need to do what they did then and cause another depression because we have to wring the excesses out of the system. And you know what? I'm glad they didn't listen to those people because, sure, it would have been, just desserts for the people who brought this whole thing upon us. That was all of us. We not every single person, but everybody who bought a house knowing that they couldn't afford it in 2 or 3 years, they were responsible. And everybody who gave the person, gave them the liar loans, they were responsible. And the people giving them AAA ratings, they were responsible. There's a lot of responsibility to go around. And so they said, no, we're not going to make that same mistake twice. And, history will tell. We're 12, 13, 14 years after the Great Recession, when the market, we were literally looking at a global financial collapse. So, enough said. Slide number 8. Because margin trading is inherently more risky, margin accounts are more highly scrutinized by brokerage firms. You may wind up with what's called a restricted account. This is a margin account whose equity is less than the initial margin requirement. The investor may not make further margin purchases and must bring the margin back to the initial margin requirement when the securities are sold. So information technology has made the brokerage firm's job of scrutinizing margin clients much easier. Right? It used to be, we're going to do it, but now it's all computerized. The computer spits out a list of customers who are restricted. Hey, you contact your customers and say, you know what, you're losing money. You either have to bring the account back up to the initial margin, or you got to sell your shares. But we're watching you. You can't do any more margin purchases. The maintenance margin is the absolute minimum amount of margin that an investor must maintain in the margin account at any time. It's typically 25 to 35%, but the Federal Reserve Bank sets the absolute minimum, and that's 25%. And the margin call is a notification of the need to bring the equity of an account whose margin is below the maintenance level up to the initial margin level, or to simply sell the shares at a big loss because you goofed, you messed up. If the investor does not meet the margin call in sufficient time, which is typically 48 hours, the brokerage firm is authorized to sell enough of the securities to meet the margin call. In other words, they don't have to have your consent. When you agreed to the margin account, you click here to agree to all these provisions. One of the provisions was, hey, if you start losing too much money and you go below, or even close in some cases, some of the brokers are even more sticky. We're gonna sell these shares. We're gonna get you out of the transaction. We know you lost a lot of money, but we don't want you to lose more. I mean, think about it. The first example we did, the person lost all their money. Now, if they lose any more, if the stock price goes down and they walk away, disappear, send a postcard from Puerto Rico or Aruba or wherever, East Jabip, the brokerage firm is on the hook. They got to make good on the margin call. They got to make good on the lost funds. That's why the first example would never be allowed these days, because that person would have gotten a margin call long before the stock went to $10, because they would have been underneath the maintenance margin. You with me? Understand? And what happened in the I'm not sure what happened in 2008 and 9 because I didn't have any. Yes, actually, it did happen in 2008 and 9 too. People were sent a margin call via email, right? They don't have to actually talk to some of these deep discount brokers. You don't actually talk to a broker. So they were sent an email overnight saying you have a margin call. You got to either sell these securities or sell these stocks, typically because the stocks were plummeting, the .com stocks. You have to sell these stocks, or we're going to sell these shares, and you're going to take a loss. Well, they were sent the email, and they didn't have time to respond. When the market opened the next day, the brokerage firm, now who did this? TD Waterhouse was the brokerage firm that did this. A few others did it too. They just went ahead, sold the shares. Get out, get out, get out. Because they don't want you to lose too much money because, again, they're on the hook for the money if you walk away. Yeah, indeed. So, of course, let's not talk about all the horrible things that can happen, Payano. Let's talk about some of the good things. If your investments do very well, then you can use the excess margin you create in your margin account to purchase additional stock without having to come up with more money. So the excess margin is more margin than is required in a margin account. Your stock has gone up, and now maybe you're no longer at 50-50, maybe you're at 75 margin, 25% margin loan. This technique is called pyramiding. I don't like that word. It's the use of excess margin from paper profits in margin accounts to partly or fully finance the acquisition of additional securities. What do you think of this strategy? Oh boy, as long as the stock prices are going up, it's great. When they start going down, you've given yourself you've put yourself in even more harm's way because you've borrowed even more money. Yeah, because it can be very, very dangerous. Speculative, that's the word. Gambling is what I use. And remember, you have to pay interest on the margin loan. They're not giving it to you for free, folks. That also adds yet another drag on your investment returns. Your margin investments must meet or exceed the margin interest rate in order for you to just break even. And we're not even discussing commissions, right? Commissions and interest. Now you know why your broker is always so happy to take your calls. Yeah, brokerage firms are not stupid. They see the banks. How do you know a bank's making money? Their doors are open. And they want to meet some too. They want to do it too. So they will loan you the money, which will allow you to hang yourself. So the question is, why would I buy on margin? And the easy answer, according to your humble instructor, is you shouldn't. The risks are not worth the potential reward, in my opinion. However, other people are going to disagree, and they're going to say, Payano's a stick in the mud. He's too stodgy. Go ahead and do it. But as we said, there is a valid, logical reason for having a margin account. It allows you to temporarily borrow against your investments without having to sell them, because if you sell your shares, then you incur the commissions and you trigger capital gains tax. But if you borrow from them, you do pay interest. So you think you'd ever want to margin securities, margin stocks? Maybe. Again, after you've been doing this a long time and you've got a sizable portfolio of high-quality stocks and you want to buy a car or something, go on a vacation or something like that, but you don't really want to sell the shares because they're good long-term investments, borrow from yourself. But you do pay interest. And if stocks go down, you might get a margin call. Oh boy. So, traditionally, the account balance sheet was what the companies used, the brokerage firms used. It's all computerized now. And I'm not sure if they still ask these questions on the Series 7. I guess I should somehow pick up a current book on the Series 7 questions. But they would show you this account balance sheet, and you had to sort of but compute what the margin was and whether or not the person's going to get a margin call. But these are not going to be on the final exam, folks. There's a worksheet, there's an answer key and a commentary, sure, But if you do take the Series 7, this is what used to be on the Series 7, but as we said, it's all computerized now, so I don't know. But those of you with accounting experience will recognize this. Assets equals liabilities plus equity, right? We usually think, we non-accounting persons think assets minus liabilities equal equity. But the accountants go, no, 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 no. On the left side of the balance sheet are the assets, on the right side are the liabilities and equity. And there's a simple formula that allows you to calculate the margin. The margin account margin, is equal to account equity divided by the total assets. So we'll see how this works on the next slide, slide 15. You purchase 100 shares at $100 each. So normally you have to come up with $10,000, right? But no, you purchased those 100 shares with $5,000. You deposit $5,000, you borrow $5,000 from your broker. So, okay, so let's look at the broker. Let's look at the account balance sheet. On the left side are the 100 shares at $10,000 for $10,000, 100 shares at $100, or your assets are $10,000, right? But on the right side, you borrowed $5,000, so that's the margin loan, and your equity is $5,000. So maybe we should have put the equity above. No, we got liabilities and equity, right? Liabilities first, and then equity below that, and the total liabilities and equity is $10,000. So this is the balance sheet, the account balance sheet, and you accountants go, okay, this is easy, I know this stuff. No, don't worry, no journal entries. We don't have to do anything spectacular. We just put the numbers in. And the account margin, as we said, is equal to the account equity divided by the total assets. So what happens if things go well? Your shares rise to 100, if your shares, I got to fix that. If the price rises to $120, not 120 shares, I got it backwards here. I got it right here over here. 100 shares at 120 per share. I'll fix it. If I don't, yell and scream at me. So your shares rise to $120, 100 shares rise to $120. So your margin is going to increase, right? This side of the balance sheet goes up because now the assets are worth $12,000. The margin loan doesn't change unless you pay it down. But the account equity now goes up to $7,000 because your shares went up in price. So you take the account equity, $7,000, divided by the total assets, $12,000, and you get 58.33% margin. You have excess margin. Congratulations. You can use the excess margin to help purchase additional shares of stock. I'm not recommending it, but that's what some people do and become fabulously wealthy until they become fabulously broke when the price goes down. Because let's do it again, but this time the price falls to $60. Your company was caught artificially inflating earnings. Uh-oh. Now the assets fall from $10,000 down to $5,000. The margin loan doesn't change. You still owe that $5,000. And now your account equity is only $1,000. So you take the account equity of $1,000 divided by the total assets of $6,000. That's a mistake. There's another mistake I made. Oh, I'm making all kinds of mistakes. Anyway, I did the calculation right. 1,000 divided by 6,000. No, wait, this is not right. I may have made a mistake. Let me do this calculation right now. 1,000, I think it's right. I think it is right. 1,000 divided by 6,000. Yes, I just wrote the wrong number. I apologize. It should be 6 here. That's 16.67%. You're going to get a margin call. And if you don't respond, they're going to sell your shares. And oh boy, they want to sell your shares quickly, right? They want to sell those $6,000 because they're going to take 5,000 of it and you're going to be left with 1,000. So instead of losing, if you'd come up with $10,000 and you would have lost $4,000 if it went from $100 to $60, you're going to lose a lot more. You're going to lose how much? You have to pay the $5,000 back, and you lost $4,000, so you lost $9,000. Ouch! 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 Look, folks, I ain't buying on margin. I don't recommend you do it because you can lose a lot of money. Now we're gonna end right now because we're gonna come back and learn to even lose more money with selling short. But when I do, I'm going to fix that the one on the slide number 16 and 17. So let's review. Buying on margin allows you to magnify your returns and allows you to magnify your losses. So the quick answer, should I do it? The answer, in my humble opinion, is no. You're going to hear other people say, oh, yeah, sure you should. But in either case, it's very dangerous. But you ain't seen nothing yet, as we said. Wait till you come back and learn about selling short. I mean, you want to lose a lot of money? This is the way to do it, folks. Don't do it. Don't do it. Don't do it. Instruction about syphilis is not an instruction to get syphilis. See you in our next presentation when we learn how to lose a whole lot of money with selling short.